All right, so in today's special episode, we're going to talk about the mysterious Chinese IPOs. This has been a trend. It's not a new trend, but it's certainly one that traders have been talking about quite a bit over the last few weeks. We've had some crazy moves in Chinese IPOs. I mean, one of the biggest was a stock that went from about $30, $40 a share up to over $2,500 a share. And I'll show you the chart on that one. It was HKD. This stock, this is the single biggest move I have ever seen. I have never seen a move that big. I've been in the market for a long time. I've never seen something like that. It was from $12. From $12 all the way up to $2,500 a share. How does that happen? Well, that's what we're going to talk about in this episode. And I'm going to share with you some of my takeaways from this recent Bloomberg article about Wall Street's mysterious 2,200% IPOs, where they're coming from. A small broker in New Jersey. But, you know, it's not just them. This stock HKD they weren't the underwriter for it. So we're going to go ahead and get started. We're going to talk about this sort of interesting subject of Chinese IPOs. And, you know, I'm hoping that I don't see a car at the end of my driveway with like diplomatic plates on it coming to get me. So I want you to know that I know Kung Fu, and I'm also an expert in the art of karaoke. So please go gentle on me. All right. So here's the thing. I don't think that this is necessarily an issue with this individual broker that's bringing IPOs onto the market. I think this is a bigger issue with market making in general. So I want to talk about market making, but let's first look at some of these recent IPOs and just, you know, sort of set the stage of how crazy they are. Okay, so HKD, obviously, absolutely insane. If you go to the NASDAQ IPO website, you can look at HKD, for instance. So HKD was the IPO. They have the auditor, company counsel. They have the underwriters here. This one particular underwriter that Bloomberg did an article about wasn't one of the underwriters of this stock. The overview here, they IPO'd at $7.80, and they offered, is it 16 million shares? Let's see, 16 million shares. All right, so they sold 16 million shares at $7.80. Now, if you want to get a calculator out, let's see, we could actually pull a Google Sheet. I'm curious exactly how much the company was valued at its peak. I mean, obviously, it became probably one of the most valuable companies on the stock exchange for just a moment, right? I mean, you could do the math yourself. It's 16 million shares times $2,555 a share. Someone do the math real quick and tell me what it is. And don't give me a bunch of commas because I don't even know how to read that big of a number. Just tell me in billions how big it is. All right, so obviously this was a crazy stock, a crazy move, and you know the underwriters and institutional traders who got a piece of this IPO potentially could have made a lot of money. So Michael's saying $40 billion, $40 billion company. And, you know, you could look at the financials of this company and ask yourself whether or not it's actually worth 40 billion. And of course, the answer is that it's not. And naturally, the price has come back down. And so this was one of the ones that triggered sort of a whole round of momentum on Chinese IPOs. But none of this is new. We've been trading Chinese small cap stocks for years and years and years. So in this article here on Bloomberg, they say Network One's microcap listings stand out for outsized moves. U.S. market transfixed by a run of Hong Kong-style wild swings. Now, I don't know a lot about the Hong Kong market and what it's been like over there, but this article says Network One Financial Securities has underwritten 6 microcap IPOs this year that have surged by an average of 2,190% on their first day of trading. Come on, are you serious? So naturally, the next IPO that they're the underwriter on, you're probably going to be thinking, I should buy it. Well, not so fast because they've also had a history of dropping 75% from the high, some as much as 98%. All right, so this is and Boosted Securities. This is an underwriter that had a lot of big, 210% is nothing to sneeze at, right? I mean, this is a big move as well. They were underwriters for a couple of huge small cap IPOs last year. I'm pretty sure WNW was an IPO that they were the underwriter on. This one went to $160 in the first day, right? Now, WNW stock. Now, I'm looking at the name and I am wondering, could it be, is that Chinese? It is. Once again. Now, okay, so we're seeing that this is common among different underwriters, but now the stock is back at 80 cents, hit a high of $160. So in this article here, they caution, of course, the risk of how much these drop. Big moves in tiny stocks are nothing new on Wall Street. Of course, that's true. And generally, as a momentum trader, I like trading these types of stocks because I like trading things that are making big moves, right? I mean, a big move is a big move. One of the most striking examples was ATXG, which soared 13,000%. ATXG. Okay, well, in fact, that move was not even as big as HKD, but it was pretty crazy. It went from $12 to $656 a share. Obviously, in that day, there was a lot of opportunity if you had the risk tolerance. And that's not going to be for everyone. You know, this is kind of like the Wild West. These are pretty crazy stocks. So it was briefly bigger than about 1/3 of S&P 500 index members, despite having less than 13 million in revenue for the year ended in March. The next day it fell to $30. All right. So, and then they say this trend is eerily familiar to market participants in Hong Kong, which was a hotbed for mysterious moves in tiny stocks before a regulatory crackdown brought new offerings to a virtual halt. So these small Chinese companies that might have otherwise listed in Hong Kong turned to the US as an alternative. And this underwriter, but they're not alone, has emerged as one of the most active players in this growing corner of the market. So now, if we look at some of the stocks that that Network One was the underwriter for, they have their website, which you could, of course, go check out. And they have under the website section, they have transactions. And so under the transactions, they note some of the other stocks that they were the underwriter for. STBX. STBX. This stock goes up to $48 in one day and then comes all the way back down to $2, right? MEG-L. MEG-L. This stock went from $49 to $249, back down at $4 now. ILAG. This one, again, huge move. It goes all the way up to $26, is back at $2 now. GSUN. This one has made moves a couple of different times to 95, sold off, came back up. Crazy move. All right. There's a couple others I'll go over in a second. So what you can see on, is this sort of this pattern, this trend. So now let's talk about and maybe, speculate for a moment. And that was just a few. They've done, you can look back, they've done so many Chinese IPOs. They did WAFU, WAFU. This was one that, was a few years ago, but has just had some crazy moves in the past. So that's one of the ones that they were the underwriter for. MDJH, you might recall. This was one that they were an underwriter for. Made some big moves. HJLI, that was another one. So there's been, there's dozens. GNPX, LFIN, they were the underwriter for LFIN. You guys probably remember that one. That was absolutely crazy, right? Okay, so Chinese, there's a bit of a trend that some of these Chinese IPOs go crazy. And hey, by the way, for those of you guys tuning in on YouTube, thank you for hitting the thumbs up. For every thumbs up we get for this episode, I'm going to donate $1 to charity. So thank you guys for hitting the thumbs up and helping this channel grow and become maybe the most popular channel for those who are interested in day trading. Let's switch over to the whiteboard and let's talk about the role of a market maker. Okay, so because I think this is an important component here. So market maker. So a market maker, as you know, probably sits on both the bid and the ask of a stock. So they'll be on the bid, sitting there to buy shares, let's say at $3. And then they'll be on the ask, sitting there to sell shares at $3.10. So when they buy a share at $3, let's say they buy 10,000 shares at $3, and then they turn around and sell those 10,000 shares at $3.10, they've made a profit of $1,000. They've made the profit across the spread. And so a market maker is allowed to do this. They're regulated and they're approved to be able to trade in this way. And of course, they use automated trading algorithms and things like that to maintain the bid-ask spread and to try to maintain a balanced position. So the best market maker at the end of each day will buy and sell an equal amount of stock. Maybe they'll buy, 500,000 shares and sell 500,000 shares, right? And maybe they'll make $50,000 between the spread. Let's just say, just for instance, right? So all day long, they'll be trading. And this will be more easily obtainable possibly on a stock that has a higher float, better liquidity. You're not going to be able to probably do that on a small cap stock, but just for instance. Now, one of the problems here is that if a stock starts surging up really, really quickly, when they're making the market and they're on both the bid and the ask, they have to be very quick to pull their order for 10,000 shares and move it up, to 320 if the stock starts moving up, and then pull it again and move it higher. They can't just sell 500,000 shares at 310, because then what happens when the stock goes to 410? They're down 500 grand. What happens when it goes to $40? They're down, $30 million or $5 million. I mean, it's it goes then to 400. You're talking about multi-million-dollar losses. And so this is the risk that market makers take. Now, they're compensated for that risk by being allowed to profit from the spread, buying on the bid and simultaneously selling on the ask. However, market makers are going to have to make a risk decision that with some stocks, they're going to choose not to make the market for them. And so what you'll find is that market makers are required to make the market for a certain number of stocks. But there can be stocks they say, no, that's too risky, not going to touch it. And so here's the problem. Now let's look at the whiteboard again. Typically, you would have, on your average stock, whatever, you would have $3, then you'd have $2.98, $2.98, $2.95, $2.90, $2.80, and then this is on the bid, and then on the ask side, you would have $3.10, $3.15, $3.21, whatever it is, $3.28. I'm just making up numbers, but you get the idea. $3.31. Okay, and these are going to be all different market makers who are making the market. All right. So here's the problem. When you have market makers who say, no, this stock is too risky, they're not going to be on the bid or the ask. They're gone. Then you have another market maker who's like, nah, I can't touch this. They're gone. Then you have another one who says, no, not for me. And then what are you left with? You're not left with many market makers. And so this creates a very thin market. There's not a lot of people making the market. And so that means who's here on the ask selling shares? Some insiders? Maybe, but usually on an IPO, what's common with IPOs? There's a lockout period. So insiders cannot sell. So then who's selling? Hardly anyone. Who's buying? People who like China stocks. People who think that these China stocks are going to go to, $100, $200. And so with lots of buyers and an absence of sellers and an absence of market makers, these stocks end up making a really big move. Now, if there was a requirement to make the market on these types of stocks, you would have better liquidity. Better liquidity would reduce the volatility. And these would most likely not make 1,000, 2,000, 15,000% moves. But, at the current time, it's not the case. And so I think that the issue here really is just that these stocks are known for being very volatile. Micro cap, small cap IPOs are known for being volatile. And as a result, there are fewer market makers that are making the market for these stocks. And that creates an absence of sellers, which then, given that we're now sort of in this little trend of this happening, creates this surge of buying. But then likewise, when the stock starts to roll over and people start saying, well, it's rolling over and I'm not going to be the guy, who buys the dip on HKD at $2,000 a share, all of a sudden you don't have any buyers on the bid. And then the bid starts just dropping, right? So now you're getting the bid drop because there's no one there to absorb sell orders. And so you get these really big swings in the market. So, I'm not here to say, what should happen. I mean, this is just the market we're in. It seems like if regulators don't like this, that they'll probably have to do something to change it. And I think it's going to have to do with market making, although they could create some minimum number of shares that a company has to IPO in order to create maybe just, more liquidity in general through that, through those means. But, realistically, it's true that there's some people out there who have made a tremendous amount of money on these stocks. And obviously, we know that most insiders are, not able to sell into these types of moves, but we don't know what kind of shady things might go on behind the scenes. We don't know, right? So we're just left here speculating if something shady happened or if this is just the result of really the mechanics of the market with a lack of market making and poor liquidity. But the fact is, these have produced some really phenomenal moves. And so, when I look at a small cap stock, my whole approach, as you guys know, not to, just be a broken record, but my whole approach is to try to find opportunity, right? And volatility is opportunity. So when I got started trading, I had a relatively small account. So I wasn't going to trade stocks like, US Steel, right? US Steel. This is a $18 stock. I mean, it moves over the course of days, but not much, a couple, 40, 30 cents. It's not predictable. So what I started realizing was that my best profits were coming from small cap stocks that were going up 20, 30, 40% in one day. And of course, when we had a stock like a DRYS or, some of these other ones that would go up 100% in one day, some of those became, massive winners for me. And so I started looking for more of those wild card stocks. And, obviously, we've had more and more of them over the last few years as we've had more interest in trading in general, as some of these small caps have IPO'd. And, it's just, and perhaps with changes in the Hong Kong market, sending more Chinese IPOs to the US market has given us more opportunities. But, my focus ultimately is just to try to find, to start with, one good trade a day. And once I've broken the ice with one good trade and I've made a little bit of profit, then I use that as a little bit of a profit cushion to take trade 2. If it works and I'm green, then trade 3, trade 4, trade 5. And, today's a day where I happen to be up, over $6,000. And my biggest loss is $100, right? My first trade was a winner. From there, I was able to start scaling up more and more and more. So I do trade these stocks on a fairly regular basis, but I try to be careful about how I manage my risk on them because I know that what goes up can come back down. And so one of the things that I talked about yesterday is that holding a loser can be much more damaging than just letting go, right? Sometimes the right thing to do is just to let it go. And so I am ruthless about cutting my losses. I don't hold in hope. I just cut the losses. I let them go. And I'm happy to get back in if there's another opportunity. And so on something like HKD, I think I had a trade on it when it was around $160 or something like that. I don't remember what it was. It was cheap. And, I got a couple trades on it on this move up, and then it started going higher and higher. And I got to a point where it was too expensive and I couldn't really afford to take big enough positions. And I said, you know what, that's fine. I'm just going to wait for the next one and look for sympathy momentum, right? Because once you have one big stock like this, often you have several others that start moving in this sympathy momentum. They start to follow the leader. So, it's a very cyclical market. And right now we're back on a, kind of China stock swing where we're seeing momentum in these Chinese IPOs and Chinese small caps. I'm going to ride the wave, but as always, I'm going to do it cautiously because trading is, of course, risky. My results are not typical, and you should, of course, make sure you take it slow. So I just want to give you this quick episode on, the mysterious Chinese IPOs. I think Bloomberg is focusing on this one underwriter, a little bit more, but there's several other underwriters that have stocks like LFIN last year that made equally outrageous moves. So they just happen to have a few right now. And I think it's just because Chinese IPOs right now are popular. And, that's the luck of the draw. They IPO'd those companies at like the perfect time. So let me know your thoughts, as always, below in the comments. I appreciate it. And if you want to check out a couple more episodes on the channel, I'll put some recommendations here and here. And I'll thank you again for hitting a thumbs up if you found this episode interesting. Every thumbs up is $1 donated to charity. So you're paying it forward through me. So thank you for doing it. And I'll see you guys back here for the morning show first thing tomorrow morning. All right. See you in the morning.